Silver just broke a level it had not broken in almost 7 months, and almost nobody is talking about what that actually means. For the first time since December 9th of last year, silver opened below $60 an ounce. Not dipped below it for a few minutes, opened there, stayed there, day after day. If you have been watching silver, you know this metal does not sit quietly at a price level unless something underneath it has shifted. So the real question is not, why did silver drop? The real question is, what happens to the price of silver now that this floor is gone? And by the end of this video, you are going to understand something about this market that most retail investors will not figure out until it is too late to act on it. Let's start with a number that should stop you in your tracks. In January of this year, silver hit an all-time high of $121.62 an ounce. That was the top of one of the most explosive rallies in the history of the metal, a surge of roughly 150% in a single year. And now, just months later, silver has fallen 42% from that peak. To most people scrolling through headlines, that looks like a rally that failed, a bubble that popped, a trade that is now over. But here is where things get interesting, because the data underneath that price action is telling a completely different story than the price chart alone. Before we go further, if this is your first time on Gold and Silver Intelligence, hit that like button and subscribe now, because what I am about to show you is the kind of setup that plays out slowly, and you do not want to miss the moments when it accelerates. So what actually happened to knock silver off its highs? It was not one thing. It was three forces hitting the market at almost the exact same moment back in February and March. When silver first pushed above $100 in late January, the exchange that runs the world's largest commodity futures market responded by sharply raising margin requirements. That might sound like a technical detail, but it is anything but. Higher margins mean any trader who borrowed money to hold a silver futures position suddenly needs to put up far more collateral just to keep that position open. When that happens across an entire market at once, leveraged traders get forced to sell, not because they want to, but because they have no choice. That selling pressure cascaded through the futures market and dragged the spot price down with it. That is the first piece of the puzzle, but it is only part of the story. Here's the detail most people miss. While speculative traders were being forced out of paper silver positions, the physical market was telling a completely different story. Solar panel manufacturers did cut their silver consumption this year, down 19%, as the industry works to thrift the amount of silver used per panel. That sounds bearish on the surface, but despite that cutback, the global silver market is still heading toward its 6th consecutive year of a supply deficit, and this year's shortfall is even wider than last year's, an estimated 46.3 million ounces short. Read that again. Even with industrial users actively trying to use less silver, the world still cannot produce enough of it. Mine supply is shrinking faster than demand is falling. That is not the signature of a metal in a collapsing bull market. That is the signature of a market where the floor is being built from underneath, while the price on your screen tells you the opposite. Now here's where the situation becomes much bigger than a single chart pattern. This week, silver strengthened back above $59 after touching 7-month lows, and the catalyst was not a silver headline at all, it was the Federal Reserve. New Fed Chair Kevin Warsh, speaking this week, acknowledged that inflation expectations had eased over the past month, and said there was no urgency to raise interest rates immediately, even while reaffirming the central bank's commitment to bringing inflation back down. Markets are now pricing in less than a 50% chance of a rate hike in September, down sharply from around 67% just days earlier, after a weak jobs report showed the US economy added only 57,000 jobs in June, the lowest total in 4 months, and far below what economists expected. Why does a jobs report in Washington move the price of a metal mined in Mexico and Peru? Because silver, unlike almost anything else you can buy, has a dual identity. It behaves like a monetary asset when real interest rates move, and it behaves like an industrial commodity when factories place orders. When the Fed signals hesitation on rate hikes, the opportunity cost of holding a non-yielding asset like silver goes down, and that alone can shift billions of dollars in positioning. But that is only part of the story too, because there is another number quietly moving in the background that deserves your full attention. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, fell from 85 to 1 down to 64 to 1 in just 5 weeks earlier this year. Historically, when that ratio compresses that fast, it does not mean the move is finished. It means the move is often just beginning. Going back through market history, every time this ratio has spiked above 80 and then started falling, silver has gone on to significantly outperform gold in the period that followed. That is not opinion. That is a pattern that has repeated across multiple economic cycles going back over half a century. So let's escalate this out, because the implications here are not limited to a single trader watching a chart. Think about what this actually touches. On an individual level, this affects anyone holding silver in an IRA, a brokerage account, or physical coins and bars, because the difference between buying near a floor and buying into a falling knife is enormous. On an industry level, this affects every solar manufacturer, every electronics producer, and every EV maker that depends on silver as an irreplaceable input, because they cannot simply substitute it away when prices rise, unlike buyers of many other commodities. On a national level, this affects countries like Mexico and Peru, which supply a huge share of the world's mined silver, and where mining policy, labor disputes, or infrastructure problems can tighten global supply overnight. And on a global level, this connects directly to the broader story of central banks, de-dollarization, and a monetary system where more countries are questioning their reliance on the US dollar as the world's reserve currency. Silver sits at the intersection of all four of those forces at the exact same time. That is what makes this moment different from a typical pullback. Now drop a comment below and tell me this. Are you watching this pullback as a warning sign, or as the accumulation opportunity of the year? I want to see where this audience stands, because the answer might surprise you when we look at what large industrial buyers are actually doing right now, not what retail traders are saying on social media. Here's what most coverage of this pullback leaves out entirely. Industrial buyers of silver, the ones who cannot function without it, are not behaving like a market that expects prices to keep falling. Reports out of major bullion markets like London have shown physical silver tightness and spiking lease rates even as the paper price on your screen was falling. That is an unusual and important divergence. It means the price you see quoted on an exchange and the price at which someone can actually get their hands on physical metal have started to separate. When that separation happens, it is usually because paper positioning, driven by leverage and margin calls, is temporarily disconnected from physical reality. Those disconnects do not last forever. Eventually, one side gives way to the other, and historically, it has been the paper price that catches up to the physical shortage, not the other way around. So where does that leave us right now, with silver sitting below $60 for the first time in almost 7 months? Analysts covering the physical market are pointing to a recovery scenario back toward the $95 to $106 range by the end of this year, built on the same forces we just walked through: a persistent supply deficit, resilient industrial demand from solar, electric vehicles, and the build-out of artificial intelligence infrastructure, and a Federal Reserve that appears to be losing its appetite for further rate hikes. That is not a guarantee. Commodity forecasts are never guarantees, and silver has a well-earned reputation for volatility that can shake out even well-informed investors. But the case is not built on hope. It is built on a widening supply deficit that has now persisted for 6 straight years, a compressing gold-to-silver ratio with a well-documented historical pattern, and a monetary backdrop that is shifting in silver's favor at the exact moment the metal is testing a major psychological floor. Here's the bigger picture most people watching the headlines are completely missing. A 42% drop from an all-time high looks, on the surface, like the end of a bull market. But underneath that price action, the fundamentals that actually drive silver over the long run, the physical deficit, the industrial demand base, and the monetary policy backdrop, have not broken down at all. If anything, several of them have gotten stronger while the price got weaker. That gap between what the price is telling you and what the fundamentals are telling you is exactly where the biggest opportunities and the biggest risks in commodity markets have always lived. The question is not whether silver lost $60, it already has. The question is whether you understand why, and what usually happens next once a market like this resets. If this breakdown gave you a clearer picture of what is actually happening in the silver market right now, share this video with someone who needs to see it before they make their next move. Hit subscribe so you do not miss the follow-up when we track whether that $60 level gets reclaimed. And I will leave you with this. When the price of something everyone needs keeps falling, while the supply of it keeps shrinking, history has a pretty consistent answer for what happens next. The only question left is timing. Let me know in the comments where you think silver goes from here.